Registered representatives offer securities through Independent Financial Group LLC, IFG, member FINRA SIPC. Investment advisor representatives offer advisory services through Independent Financial Group LLC, IFG, a registered investment advisor. Cornerstone Wealth Management, Allianz Life, and IFG are unaffiliated entities. The information and opinions presented are for general information only and are not intended to provide specific advice or recommendations for any individual. You should contact your investment representative, attorney, accountant, or tax advisor with regard to your individual situation. The opinions of the presenter do not necessarily reflect those of Independent Financial Group LLC, its affiliates, officers, or directors.
If you're nearing retirement or worried if what you've saved is going to last, then this is the podcast for you. Now let's join Cornerstone co-founder Jamie Avila for the Cornerstone Retirement Blueprint Podcast.
Thank you for joining us today. My name is Jamie Avila. I am the managing partner of Cornerstone Wealth Management. Welcome to the Cornerstone Retirement Podcast. We have with us today Sal Capizzi from Denham Trust Company. We just finished a donor advised fund podcast, which it was excellent, a lot of good information. This is part 2 in that series that we're doing, and we are going to be focusing today on what my clients ask me a lot about. Jamie, what is this charitable remainder trust that I'm hearing about? How does it work? How can it benefit me? And so I think one of the first things that I want to kind of bring up is maybe what a lot of people look to this for is they want to give, right? Like we talked about donor advised fund, but also how can it benefit them? And I think the avatar client that probably would really appreciate this would be somebody that's holding something that's highly appreciated, right? Like a stock, or they're selling a business or something like that, right, Sal?
Correct. And Jamie, typically you will have a person who's interested in the charitable remainder trust is going to be someone that has a highly appreciated asset. And what they're seeking to do is eliminate the tax at the point of sale, like completely eliminating it. And you bring up a good point, because most people, they do not want to sell their stock or their real estate because all the taxes are going to have to pay. It's exactly.
Like, I don't want to deal with that. I'll just keep deferring it and we'll figure it out later.
And if you're lucky like me and you're able to live in California,
you're so lucky.
You're
lucky because of the weather. The weather's the only thing California is bringing these days. All right, everything else is running everybody out.
we pay for the weather in a 13.3% state tax on top of the federal and on top of the Medicare tax, right?
Wow.
So the tax becomes extremely large. Now you mentioned we did a podcast on the donor advised fund, and typically a donor advised fund, you really have to have charitable intent in order to really appreciate the benefit that brings. It's funny, but on a charitable remainder trust, you may not be as charitably inclined and still find the benefit of using it quite compelling.
Interesting. All right. Well, please, the viewers want to know. How does that work for them?
So let's take a purely hypothetical situation. Let's assume for a moment that I am selling a business.
Okay.
Right? And let's assume it's a service business, so I really don't have any cost basis associated with it, right? So when you're selling a business, right, that you typically have
You're talking more like a professional, like a dentist or doctor. Correct. Or something like that.
Correct.
Okay.
Or even in your
financial
business.
Advisor.
Right.
Yeah.
Your cost basis is going to be zero because it's more of a service oriented. You're not buying machinery. There's no heavy equipment outside. So you tend to have a really, really large tax bill. Now, this could also be, by the way, we're using the sale of a business as an example, but this could be if I bought Tesla stock, I bought Apple stock, and I just have a lot of appreciation on it. It could be real estate where I've basically depreciated the real estate down to zero, where if I sell it, I could wind up with a tax bill. So it's any type of asset where your head starts to hurt when your CPA tells you what the tax bill is going to be, what the check that you need to write in the April 15th after the year that you sell it. So it's $3 million business is being sold, right? If you place this in if you were just to sell it, right, you would have a 20% federal tax, right? And then you would have whatever the state tax is. So out here in Nevada, you don't have to worry about that.
But we do have to worry about the Obama tax.
Correct.
That 3.8, right?
Correct. So and on real estate, on stocks and all of those, you're absolutely correct. You got to add that on. So basically almost 24% would be going in taxes. On a business, you certain times, you're right, sometimes you do owe that 3.8, certain times you do not. So there are ways of escaping that the CPA will kind of look into, and they'll let you know. But still, you're looking at $600,000 that will be going out at a 20% tax rate. If that was the only thing you had to worry about on a $3 million sale, right? 20% of $3 million is $600,000. That would be going to the government, right? So the question is, why?
Yeah, my hand would be shaking at that check,
But Jamie, I want you to think about your listeners who may be in Illinois, who may be in New York, who may be in New Jersey, and the ones in California, because now what you're talking about, so living in California, I'm subject to a 20% federal, I'm subject to a 13.3% state, and then if I'm subject to the Medicare tax of 3.8, 37%
wow.
of what I made, right? My sweat that created that asset goes to the government.
Well, I'm glad that this administration hasn't got their way yet in raising capital gains tax, right? Because that would be even a bigger nightmare.
We got real close, but it may not be over.
Yeah, I'm sure it's still on the table.
Yep.
But it is something for people to think about, because sometimes timing is everything. And I think we may look back 5-10 years ago or in the future and say, wow, I should have probably sold it back then when it was a lot more palatable, But this is good. So in this example, $600,000, normally they would have to cut a check for on the low end.
Correct.
And that would be what would happen. And they would take their $2.4 million right off to the sunset and do whatever they need to do with it.
Well, they would give it to you, and you would now try to create income off of the $2.4 million. So if they're selling their business, they need to replace the income that the business may have been delivering to their family. So, but now you only have $2.4 million. Mm-hmm. What if you had the full $3 million?
Oh, that'd be even easier for me.
That'd
make my job easier.
Well, but what it also means is more income, right? So how does the charitable remainder trust work? Right. So what you're basically doing is you're saying, I'm going to take my business, but what I'm going to do is I'm going to place it into the charitable remainder trust. Right. So let's assume for a moment, Jamie, that I'm buying your practice, and let's assume I'm buying your practice for that $3 million. Right.
I'm not selling.
I know.
I need $20 million at least, so up it up.
Well, with the size of your practice, that may be the case. But again, just from a hypothetical situation, let's assume for a moment that you're selling it for $3 million.
Okay.
The mechanics, right? Yeah. How does it work, right? What you would do is you would literally transfer your business interest into the trust. Now, the trust is a recognized tax-exempt entity by IRS. Most trusts aren't. This trust has a superpower that most other trusts do not have, because it is recognized as a tax-exempt entity. So basically, you'd be placing your business interest in the trust, and then I, as the buyer, I'll buy your business interest from the trust. Gotcha. So it's the trust selling it.
And that's how you avoid having to pay taxes.
Bingo. You nailed it.
Okay.
Right? So now that $600,000, instead of going out to Uncle Sam, now is sitting in the trust for you to manage and to make income, right? But it's not all great, right? There are things that you do need to consider. One of the things you need to consider is the fact that the name of the trust is a charitable remainder trust,
Okay.
right? So where does that name come from? The way a charitable remainder trust works is you would become what we call the income beneficiary of the trust, right? You sold the practice, you're going to be receiving the income, right? So
you're entitled to that income stream from the trust
for your entire life.
Gotcha.
So it's lifetime income.
Gotcha.
Right? However, when you pass away, the remainder, whatever remains in the trust, then goes to a charity.
Hence the word charitable
Remainder trust. Correct.
Okay, I get it. So
now, the good side is that there is a tax benefit that you also receive. So not only have you eliminated the capital gains tax at the point of sale, but you also will receive a tax deduction.
So it's like a 2-for-1.
Correct.
Everybody likes 2-for-1s, right? I mean, at the end of the day, you're getting an extra added benefit. So like you said, you're avoiding the taxes off the sale and you're getting a tax deduction for doing the CRT.
Now, this is where it becomes slightly complicated. So, Jamie, you always do a great job of kind of taking this and then making it easier. So, if it gets complicated for your listeners, then stop me.
Yep.
So, in order to have a charitable remainder trust, and in order to have those tax benefits that we just discussed, IRS has some rules that you have to some tests that you have to follow.
Yeah, there's strings attached, right? At the end of the day, they're not just giving away these things for free. There's things to consider on the opposite side.
Correct, because you are getting a benefit. Now, the test is an entrance exam only, right? So the way it works is you have to pull out 5% a year from the trust. That's the minimum that they want you to do. So because the growth in the trust is all tax deferred, they want to make sure that you're pulling money out, right? So this does not work for young people. In fact, as we stand today, if you're 28 years of age or younger, this will not work, right? But for anyone over 28, it should work. And the reason it doesn't work is simply they're so young that IRS takes a look at the actual aerial age that they pass away.
Yeah, it's life expectancy, right? It's just
correct.
Too long.
You have to leave 10% of the principal in the trust. It has to be in there when actuarially you pass away. Again, entrance exam.
Gotcha.
If you live to be 150 and there's only 32 cents left in the trust, that's fine, right? It's just that from when you start the trust, they take a look at when actuarially you're supposed to die. Then is there still 10%?
So in this example, we're talking about $3 million CRT. There's got to at least be $300,000 left in the trust to leave to a charity.
Bingo. And guess what your tax deduction is?
10%.
$300,000.
So it's okay. Well, that makes sense,
right? Because that's going to be the gift, right? Based on because in this case we're optimizing the trust for the income beneficiary. So what we're doing is we're trying to give them as much as we can. So the 10% that's left, right? That's your deduction. Okay. So not only did you eliminate the capital gains tax at point of sale, but now you have an additional $300,000 you can use towards other income.
Yeah, that's awesome. So yeah, it's really helping them avoid taxation on the sale, getting a tax deduction as well. Now let's just say, for instance, we do a good job at managing the money and the CRT either maintains its value based on what they've taken over 20, 30 years, or it's grown a little bit, right? And now it's worth $4 million. How, some people might be saying, well, wow, that's a lot to leave to charity. Maybe I want to leave it to my children or a portion of it. Can that happen? Or is it, I assume because it's a CRT, it's got to go to the charity. And if that has to happen, are there alternatives to consider the children?
All right. So you want a strategy, Jamie, where you can have your cake and eat it too.
I like that. There's nothing wrong with that, right, Sal?
So the answer is yes. So what you might want to think about is utilizing life insurance to replace some or all of the assets that would wind up going to charity. But here's the thing that's interesting. Remember I said you saved $600,000 of, in our hypothetical example, we saved $600,000 of capital gains tax. Remember I said that if we optimize it so that only 10% is left, in other words, you can pull out 90% of the value for you and your family of the business, right? You got a $300,000 tax deduction. What if we use the tax savings? What if we, in essence, had the government paying for some or even all of the premium, depending on the age of your listener?
Oh, I like that. And I know they'll like that.
Right. So
because you know how it is, any type of premium, I don't care what you pay, whether it's an automobile premium, life insurance premium, you kind of dread having to pay it, right? And you wonder, well, am I ever going to have to use this? But it's defensive. It's a defensive measure. But the thought of somebody else paying that bill for me actually puts a smile on my face.
Right, correct. So it's not uncommon to use life insurance, together with a CRT, and this way now you're able to have that lifetime income, and it can be, and you could arrange the trust in any way that you want. So you mentioned you did a great job and the trust was growing. You could make it so that you continue to take more income then. As opposed to this,
for instance, to not complicate, like let's say they're taking 5% on a $3 million CRT. It's $150,000 a year,
correct?
Right. So what are you saying at that point? If you introduce maybe the life insurance strategy, so that, like you said, you have your cake and eat it too. The charity gets what they get, and your kids get what they get. You just raise your income a little bit to cover that expense. Is that what you're saying?
No. So what I'm saying is so the way you get to only leaving 10%, right? Because that's the beauty. I mean, you could still, IRS will allow you to take 90% of the asset back into your family, right? But you're leaving that 10%, or if you die too soon, right? So if you set up the trust, if I set up a trust and literally, I leave the attorney's office and I pass away, the charity has a windfall, or donor advised fund, whichever you're using has a windfall, right? But assuming that I'm living through a normal life expectancy,
and your wife, right? Because is it applicable to your spouse?
Correct.
So if one spouse is still alive, it continues. Gotcha. Okay. Gotcha.
Correct. So what you wind up doing is you wind up having using your, let's assume for a moment that based on my age, I can pull out 10% of the value of the trust every year.
Gotcha.
Because remember, we have to leave that 10%, right? So mathematically, we figured that all out. So if it's 10% on $3 million, that's $300,000. But let's assume for a moment that you're doing a great job, and now it grew to a little bit more. So you could actually keep so you could actually start receiving more money than you would receive. Now, at 10%, I guarantee you will bring the asset down.
Absolutely.
Because you're not going to earn 10%.
Yeah, it's aggressive withdrawal. Yeah.
But if you were at 5%, using your example, even if you were earning 6%, right? If you're pulling out 5 and you're earning 6, right? Math says, and remember, all tax deferred, right? It has to be growing, which means now your income is growing.
Gotcha.
So the beauty of a charitable remainder trust is that you will design it based specifically on the needs of the individual client. and what they want to see,
Gotcha.
how much tax deduction they want, and how much income they want for the rest of their lives.
That's awesome, Sal. I feel like you just finished like a storybook fairy tale ending, for
You mean
the,
like
for
the
listeners.
Chiefs game this past weekend?
That's brutal for all the Buffalo fans out there. But no, this is great. This has been enlightening. Every time I speak to you, I learn more about how the CRTs work and how they can benefit our clients. And, for the right client in the right circumstance, this is just an incredible way to eliminate taxes in some way or another, and to get a deduction. And so you may be sitting there listening saying, this kind of sounds like me. I have a business that I want to sell and I'm going to have this windfall, or I bought Tesla when it was $50 and now it's split and it's worth 800, 900, whatever it is. If you own a highly appreciated asset, this is probably something you should learn about and consider. Sal, it's been great. Thank you for educating us, and thank you for being such a resource to Cornerstone, because you're a great partner.
Well, it's pleasure as always.
And so thanks. That'll wrap up the show today. We appreciate you listening today, and we look forward to segment 3 with Sal and wrapping up the series.
Registered representatives offer securities through Independent Financial Group LLC, IFG, member FINRA SIPC. Investment advisor representatives offer advisory services through Independent Financial Group LLC, IFG, a registered investment advisor. Cornerstone Wealth Management, Alliance Life, and IFG are unaffiliated entities. The information and opinions presented are for general information only and are not intended to provide specific advice or recommendations for any individual. You should contact your investment representative, attorney, accountant, or tax advisor with regard to your individual situation. The opinions of the presenter do not necessarily reflect those of Independent Financial Group LLC, its affiliates, officers, or directors.